All right, good morning, Alta agents. This is Kevin Lauren. I'm the Director of Training and Marketing here. And today we're going to be joined by Peter Zomick from Arrival Home Loans. And we're going to be discussing bridge loans, which is a really important product that everybody needs to know about. But before we get into today's presentation, I'm going to bring Bill Seitz, the corporate broker of Alta Realty Group, on the line. Good morning, Bill. How are you today?
Hey, good morning, Kevin. Good morning, everybody.
All right, it's good to have Peter with us, and we'll get to Peter in just a few minutes here. Before that, Bill, any updates that you'd like to go over?
I just on the Broker Tuesday tip this week, just reminding everybody that a lot of our local markets are, they're kind of slowing down as far as appreciation. Doesn't mean transactionally that we're slowing down, but just the rate of appreciation. And so that ties into all the things, Kevin, that we talked about in the last several months, if not weeks, about pricing the home correctly, educating your sellers. And I think we've gone through a number of tools and techniques and data reports and things that'll help you be able to educate your sellers. So it's just a reminder that, we want to have success when we sell real estate. We don't want to have things sitting on the market for, 200 days. And it really comes down to us to make sure that we're really in the know with, this type of stuff. And so, whether it's Altos reports or the report that we shared that we can pull from United Wholesale, or, however you're getting your information from title via property profiles, making sure that you're really dialed into your data and making sure that you can educate your sellers. Nothing worse than going on the market, paying for the marketing, and having one showing a week, if that, and wondering why your house isn't moving or you're getting any activity. So just a reminder, it's our responsibility to do those things. And even in a little bit less active market, we can still be successful in getting the transaction to the finish line if we know how to approach it the right way.
Now, very well said, because we are absolutely seeing that softening of home prices right now. We all saw it coming, everything was overpriced to begin with, so that's happening now.
Yeah, and it's midsummer, so seasonally we're also in the middle of school, and families are taking vacations and maybe pumping the brakes on making the move. I mean, I have a client that I've been working with for a while, and they've missed out on a couple properties, and they're kind of like, oh well, kids are kind of already dialed in with school. Maybe we'll just wait. So there's still a little bit of that going on, and but yeah, it's not abnormal for this time of year. It probably will pick up again in the next month or two. But if you're working on transaction now, make sure you're aware of all those factors.
For sure.
And
Well,
Kevin, let me just do the quick intro for Peter, because I came across Arrival Home Loans from a friend of mine that works in finance, and we're actually helping Leanne Thomas with the situation. And this is where it really come into play for all you agents out there. It was the client scenario was, it was a older couple, not retired yet. Their son and grandchildren had just moved to somewhere out, I think in Marietta, and they wanted to, they're a very close family. They want to, downsize and live close to the son and the grandchildren. And so they were, they didn't have their house on the market yet. The house that they really loved came on the market, and, they needed a mechanism to bridge, right, the equity out of their home into this new purchase next to their kids. So as Bridge states, Bridge is, connecting one thing to another, place. You're bridging something. But this is a really important tool. And I think Peter's going to give us a really good education on this, on how to navigate when your client isn't ready maybe to sell or right away, but they have to move and they have a ton of equity tied up in their, either current residence. So with that being said, it's a very, very effective tool. I know it maybe doesn't happen, each of us maybe a couple times a year, or maybe not, some years doesn't happen, but to know how to use this tool and how you can get your transactions to the finish line is very important. And knowing this is super effective when this situation arises.
Perfect. Well, with that said, Peter, you can go ahead and take it away, and you should be able to share your screen. All right.
All right. Hopefully you guys can see my screen share. Yes.
Yep, it is firing up.
Perfect. Yes. I'll make sure that Kevin and Bill have a copy of this deck afterwards so that you guys will be able to, review it. But I'm Peter Zomick. I'm the Vice President of Sales and Business Development with Arrival Home Loans, and we are a residential consumer bridge lender. We believe that we have a unique solution unlike any of our peers in the marketplace. And so we're going to talk today about the power of what we call our singular solution of our unique and modern day approach to consumer bridge lending. We're a wholesale company, so we do not do loans for consumers directly for the most part. They go through brokers or lenders that we have wholesale relationships with, and we kind of facilitate the processing, underwriting, and funding of those loans. And so we're going to talk today about our solution, but I want to first talk about the problem so that you can appreciate the power of the solution that we provide. Right? There's a lot of folks out in the marketplace that want to buy a new home, and they currently own a home now, and they don't think they can go buy a new home because they can't qualify for 2 mortgages. And for the most part, that's probably correct. It may blow their debt to income ratios. However, we've seen over the last 2.5 years, these companies come on the market that offer what we call these guaranteed backup offers, where, for a fee, they will put a non-contingent offer on somebody's house. Unfortunately, it's usually, a low value offer, usually 70 cents on the dollar, but they will put an offer non-contingent on that home. And when that happens, the GSEs, Fannie Mae and Freddie Mac say, okay, since you have a non-contingent offer on your home, we can eliminate the current principal, interest, taxes, and insurance mortgage you have on your current home. And now you can go and qualify for a new purchase mortgage and not have to include that mortgage payment, so that from a debt to income standpoint, you can qualify. It did solve a need, but we don't really believe it's in the best interest of a consumer, because a consumer has either 60 or 90 days to try to find somebody else to buy that home for more, or they're stuck selling it for a lower price and they paid a fee to do that. But it also begs the question, Bill mentioned that we are entering a little bit of a softer market, but still today in America, there is record equity in homes. And so just because now they can qualify from a ratio standpoint to get a new purchase money mortgage, where is the money for the down payment going to come from? A lot of folks have tied up assets or are going to have penalties if they try to liquidate some of those assets. And so they need to unlock some of the equity from their current home. And so that's where your traditional bridge lenders would come in. They'd, pay off the first mortgage on the current home. That is usually a low interest rate mortgage, and replace it with a bridge loan with a higher interest rate mortgage, and give them enough money to put a nice down payment on the new home. And then they can go and qualify for a new purchase money mortgage. So if you think about that solution set, it's 3 transactions to have somebody buy before they sell, right? One is the guaranteed backup offer. 2 is getting a traditional bridge loan or a home equity line of credit or a swing loan to get money out for a down payment. And then the 3rd is to go and get a purchase money mortgage to qualify for the new home. So that's 3 transactions, 3 sets of fees, 3 closing costs, 3 contracts, 3 sets of paperwork. We think there's a better way. Some folks are also afraid to put their home on the market right now because it may sell before they find a new home. And then they got to move all their things into storage, find temporary housing, which can be expensive and cumbersome, and then try to time the ending of the temporary housing with the finding and closing of a new home purchase, which can be challenging as well. And then we all know some folks that have lived in their home so long that they really need to get out of that home and do some minor renovations and improvements, maybe even professionally stage it to maximize the sales price of that home. And it's really tough to sell a home and do all those things while you're still living in it. Traditional lenders and conventional loans fall short of the solution that's needed to have somebody buy before they sell in the most effective manner. Arrival Home Loans comes into the picture because we offer a singular solution where with one loan, one transaction, one set of paperwork, one set of closing costs, one set of underwriting guidelines. We unlock the equity in somebody's current home and complete the purchase of the new home quickly. And so let's talk about what we do and how we do it. I'll open it up for questions at the end. If you have questions now and you think you may forget it, go ahead and drop it in the chat and we'll address those as we get towards the end. So there's really only three reasons, why you should think of Arrival Home Loans. We'll get into that in a little bit more, but the first reason is anybody that currently owns a home that is looking to buy a new home before they sell their existing one is the first reason. The second reason is if you have somebody that really wants to buy a new home and wants to make a non-contingent offer so they can truly compete with 43% of the buyers out in the marketplace, which are cash buyers according to Redfin, you should come to Arrival Home Loans. We will do formal pre-approvals, we'll do TBD underwrites so that your buyers can make a true bona fide non-contingent offer on a new home without having to worry about selling their existing home first. And then the third reason you should think about Arrival Home Loans is unfortunately, things go south. Stuff happens and transactions go sideways, whether it's through what I call the domino effect, where, I'm looking to go buy a new home and I'm under contract to buy that new home. And simultaneously, I'm selling my existing home and I have a buyer for that home and everything's moving along and everyone's getting qualified and we're getting closer and closer and closer to closing day. And the buyer of my home now has a problem and they can't close on time, which is going to cause me not to be able to close on time for the home that I want to buy and risk losing my earnest money, risk losing the ability to extend, risk losing the whole transaction and losing the home. You should think of Arrival Home Loans for any last minute jumbo or conventional fallout through a purchase. So those are really the three reasons. But what we do is we encumber two properties through what we call cross-collateralization, and that allows for higher loan amounts. Our loan actually is the purchase money transaction. It's not just a cash out to give for a down payment. It is a short-term solution that requires what we call an exit strategy, and we'll talk about that in just a minute. So what we do is we use the equity in their existing home and what we call the potential equity in the new home for the full purchase price or more of that new home. And so let's get into the guidelines where the rubber really meets the road and where you can see the power of our solution and how it's not kind of your grandma's bridge loan, but more of a high octane turbocharged solution. So first, for our product, there must be a primary residence or a second home component to this. They must be purchasing a primary residence or a second home. However, that being said, we're owned by a company called Pacific Private Money, which is an alternative finance lender in the business purpose space, and they do investment property bridge loans, ground up construction, fix and flip, DSCR. So if you need something that's kind of not in our wheelhouse, you can still reach out to Don, who's your AE. I'll introduce you to him in just a little bit. And he can help, facilitate some of those transactions to make them work for you as well. Our term is an 11-month balloon. We require interest-only payments, and there's no prepayment penalty, and there's no EPO on the mortgage broker side. Although our term is 11 months, on average, our loans pay off in 4.5 months. Talk about that in just a little bit. We offer a max combined loan to value of 75%. But you need to remember, and we'll run through an example of how you calculate a loan amount in just a minute. It's not 75% of the new home purchase, and it's not 75% of the departing home. It's 75% of both of the homes. That's where the power of our solution really comes into play. We do require a minimum middle credit score of 680. So if you have a borrower that's slightly under 680 and a Clearview, you guys have access to, either credit simulators or rapid rescore, I encourage you to try to get that borrower's credit score over 680 because we do kind of have a hard stop under 680. The loan amount can be higher than the purchase price. Now, let's let that sink in for a minute. The loan amount can be higher than the purchase price. Well, why the heck would somebody want to borrow more than 100% of the purchase price of the home they're buying? Great question. There's three primary reasons. One, unlike some other bridge loans that don't require any payments and they're just tacking on interest to the back end of the loan each month until that loan pays off, we actually require interest-only payments. And so sometimes adding a larger interest-only payment on top of all their current monthly financial obligations can really blow their debt-to-income ratio out of the water. And they may have some financial hardship, and they need additional funds to be able to make those bridge payments while they have our bridge. Well, guess what? If the equity allows, we will allow them to get cash back on the funding of the purchase. They can take that money, put it in their own bank account, and as the interest-only mortgage payment becomes due each month, they could make that payment without any financial hardship and continue to live life as they've always known it. Very powerful. The second reason is some folks, again, have the equity locked up. They need to unlock a little bit more. So when they move into that new home and they vacate their departing home, they could do some new painting, maybe replace the carpet, professionally stage it, enhance curb appeal, so it'll sell faster and for a higher dollar. And then the last reason we're seeing some folks borrow more than the loan amount is it is a tighter market. There isn't a ton of inventory. And although folks are finding some homes they like, they're not perfect. And so they want to do some minor renovations and improvements to the new home. If the equity allows, we'll allow them to get additional money over and above the purchase. All right, so the borrower must have a viable exit plan. The exit plan in a nutshell is, what's the strategy to make sure that we're paid off within 11 months or sooner? In the history of us doing this loan, we've never had a borrower default, we've never foreclosed on a borrower, and we've never lost any of our investors' money. So I'm going to get into kind of our guidelines here, which seem a little loosey-goosey, but just understand we're giving good loans to good people that we know are going to be able to make the payments and be able to get out of our loan on time. Our loans are reduced alternative documentation loans. So if you guys have been around prior to 2005 to 2008 mortgage meltdown, 2003 and 4, we had a lot of these stated products that were on the market for mortgages. Well, we offer what's called a SEVA loan. It's a stated income verified asset loan. We do not verify income. As long as the income that's stated on the application is reasonable, the underwriters will take that and move on. We do like to verify assets, and typically we like to see 6 months of reserves in assets. It doesn't necessarily need to be liquid. It can be invested. It can be in retirement funds, but we want to see it. And in many cases, we'll actually include the cash back that they're getting from the purchase into those assets for reserves. We don't require appraisals on the surface. We do internal automated valuations, which are electronic appraisals from the desktop. And if those values come in at an acceptable range to do the loan at the amount that the borrowers need, then we don't need any appraisals. However, if you're confident that the AVM that we came up with for one or both of the homes is low, and you knowing the market know that it will actually appraise more, you can elect to have appraisals done on those properties. Just the same, if you're coming to us to save a deal that's at risk of falling out and you already have an appraisal, as long as it's AIR compliant and it's a solid appraisal, we can use that appraisal. All right, so unlike some other bridge loans, we don't require their current home be under contract. We don't even require the current home be listed at the time that we close our bridge. That's another big difference. The cross property is normally their departing residence, which is a primary residence, but it doesn't have to be. Some folks may own multiple properties. As long as it's residential in nature, it could be a second home or a 1 to 4 unit investment property. All right, let's talk about the exit strategy. Because we underwrite predominantly based on the ability to exit, there are no debt to income restrictions in our loans. We have a loan closing today with 112% DTI. Where you're like, well, how the heck are they going to make the payments if it's 112%? Well, one, they have assets that they're able to draw upon to make the payments. And two, their current home that is departing is not only on the market right now, it's actually under contract. But if they didn't close now, they were going to lose the home that they really wanted. And so the bridge made good sense for them. So here's what typically happens. They close on the bridge, they move out of their current home, they move into the new home, and they do what they need to do for the departing home. They do some renovations, they throw some paint, whatever they're going to do, and they get it on the market. When that home sells, we will take a portion of the proceeds of the sale of the departing home and have the consumer pay down a portion of the bridge loan. And in exchange for paying down a portion of the bridge loan, which on the deed of trust, the language we use is something called a release clause, but I'm not going to get into the details of that in this call right now. Then what happens is they still have a lower balance bridge only on the new purchase. The mortgage broker who did the bridge with us to begin with now gets an opportunity at a second loan without the fear of flipping and without our involvement to come in and do a rate and term refinance on the subject property that they just purchased to pay the rest of the bridge loan off. So you guys can get paid twice, once on the bridge and again on what we call the takeout loan. That's 85% of the time there's a rate and term refinance involved in paying the bridge off completely. 15% of the time, consumers will sell other assets or investments. They may coming into money through an inheritance and things like that. But it's very important to have a solid exit strategy if you want a loan with Arrival Home Loans. Now, you may ask, well, crap, what happens if their home doesn't sell, and the 11 months is coming up and they're trying to sell it? Like I said, we've never had a borrower default. We've never foreclosed. As long as the house that needs to sell is on the market, as long as it's reasonably priced and they're doing what they can and they're making the payments on the bridge, we'll offer an automatic 60-day extension on that 11-month bridge and even go beyond that if we need to. But I can count in the time that I've been here in 2 years on 2 fingers how many times we've actually had to do that. All right, so let's talk about how it works. We're going to do an example of calculating a loan amount. All right, in this scenario, we have an older couple. They've raised their kids in this house, been there for quite some time. Their kids are out of the house and have kids of their own. The home is worth $1 million. They only owe $200,000 on it because they've been paying on it for such a long time. And they want to move a little bit closer to their kids and grandkids into an active adult community at $800,000. And they have over a 680 credit score. So let's do some mortgage math based upon a 75% maximum CLTV. So we add the $1 million current home versus the $800,000 purchase, we have $1.8 million. We take 75% of that, we have $1.35 million. Let's pause for 1 minute because we have to account for that existing first mortgage at $200,000. We are one of the few bridge lenders that will agree to sit in second lien position on the departing residents. That means they don't have to pay off their low interest rate first mortgage on their current home and replace it with a higher bridge loan interest rate, which we'll talk about in just a few minutes. So once we back out the $200,000 first mortgage into the CLTV calculation, we're left with $1.15 million. So based upon these figures, not only can these borrowers borrow all $800,000 for the purchase, they can borrow more if they want. Maybe when they move out, like I said, they've been living in this house for quite some time, so surely they may need to kind of touch it up and make it look better and more attractive to some buyers that are coming through. Maybe they want to professionally stage it. Maybe these folks are on fixed income. Maybe the assets that they currently have, they're dissipating each month and using that as income, and they're not made of money, and they need a little bit to maybe make the interest-only bridge payments as well while they have the bridge. That's why Arrival Home Loans' singular solution is such a great option for folks that want to buy before they sell. All right, so I talked about 3 reasons why you should be thinking about Arrival Home Loans, right? Folks who want to buy before they sell, folks who want to make true bona fide non-contingent offers, and then folks that have last-minute conventional jumbo fallout. But here are some other reasons that you want to think about as you're talking and working with people who could be a good candidate for an Arrival Home Loans consumer bridge loan. All right, let's run through a few case studies so you can kind of see, how this all comes into play. So this one was actually about 1.5 years ago or so. It was a jumbo borrower who was pre-approved with a jumbo lender several months before they actually found the new property. However, tax season came and they needed to file their taxes in order to qualify for the loan now. If they would have found the home based upon last year's tax returns, they would have been fine. But they didn't find a home until several months later when new tax season came out and taxes were due, and it was no longer valid, the old tax returns. So the jumbo lender said, sorry, we can't do this loan anymore until you file your tax returns. Borrower's like, I'm not ready to file my tax returns. You already pre-approved me. And they kind of got in a little spiff back and forth, and the consumer just didn't understand, the depth of mortgage qualification as it applies to self-employment. He was putting 30% down, put $120,000 earnest money, and was at risk of losing that earnest money. The clients came to us. We gave them a $3 million bridge and closed this loan in 10 days. We saved them. 7 months later, he was able to file his tax returns and find a jumbo lender after filing his tax returns who was able to help pay off the bridge and get him into a longer-term mortgage strategy. This is a fast-closed move-up borrower where they plan to sell their home in the spring. They started dabbling on the internet in the winter, and lo and behold, in the winter, they found a home they loved, but they weren't ready to sell their home until the spring. And they were well qualified, but they couldn't qualify for 2 mortgages, and they knew that the seller would not accept a contingent offer. They were bummed out. The loan officer they were working with was set up to work with us, referred them over to us. We give them a $2 million bridge. The borrowers could win their offer, complete the purchase, and move on their schedule. And springtime came 4 months later. They sold their current home, paid down the bridge, and then refinanced into a longer-term mortgage strategy with the loan officer who came to us with the bridge. Here's one real quick. A borrower had credit issue. They had a tax lien that showed up on the credit report, but did not show up on title to their departing home. The borrowers were trying to tell the lender they were working with that it was recorded in error and that they have the documentation, and the conventional lender said, until this gets removed from the credit report, we can't move forward. Well, they were disappointed, but they came to us through a wholesale relationship. And due to the subjectivity allowed in our underwriting process, because we don't follow anybody else's underwriting guidelines, we are the wholesale lender. We create our own guidelines. And so there is a level of subjectivity allowed. The borrowers provided us with the documentation. We thought it was evident that, yes, it was in error, but it was also the IRS that they were dealing with, and probably was going to take a few months to get it all cleared up and removed. We gave them a bridge loan for $950,000. Several months later, they got that tax lien removed off of their credit and were able to refinance into a longer mortgage term strategy. I don't know how much this may apply to you guys, but we are the only bridge lender in the country that I know that allows for multi-state cross-collateralized loans. In this instance, we had a borrower couple who lived in California and wanted to retire and purchase a new construction in Arizona. However, the builder that they loved in Arizona would not accept a contingent offer and told them that it would be about 7 months build time. And due to all of the options that the borrowers were able to pick out, they didn't want a contingent offer. And the buyers didn't want to sell their home 7 months too soon and rent. And so they came to us. And so we gave them a pre-approval for the purchase. They were able to make a bona fide non-contingent offer. We sat on the sidelines for about 7 months until the home was ready. When they got their certificate of occupancy, we were able to close and fund on the bridge loan and get them into the home. After they moved into the home in Arizona, they went ahead and went back and sold their home in California. So you can kind of see how these bridge loans work, as we go through them. One of the things that you do need to know about our loans, because of the points and fees, the interest rates, the type of loan we have, and the short-term nature of it, our loans are considered Section 32 high-cost HOPA loans. Don't let that scare you. It's just a formality, and there's a little additional hoops to jump through. Because it's a Section 32 loan, all borrowers are required to take a high-cost home loan counseling course from a HUD-endorsed housing counseling agency. We have several HUD-endorsed counseling agencies that we work with. We could recommend them to you and help kind of coordinate and schedule these classes. Usually they're on the phone for about 20 to 30 minutes. They cost about $189 or so, and they get a certificate after the course, of which we need that certificate before we will send the initial closing disclosure. If you're not familiar with what these housing counselors are talking about on the phone, one, we've never had a borrower withdraw their application, and get spooked and scared after attending one of these housing courses. There's 2 primary things that the counselors are wanting to ensure that the borrowers are aware of. One, can they make the payments, not only on their current obligations, but on this bridge while they have it? And two, have they considered any alternative products that may be able to meet the same goal as our bridge loan? Really, that is it. And so there's one other caveat when it comes to Section 32 loans, and that is the points and fees, which is Section 1 of the loan estimate, cannot be financed into the loan. Seller can pay it, builders can pay it, or the borrowers can pay it. But if the borrowers pay it, it cannot be financed. However, the earnest money deposit given for the transaction, we consider as a contribution into the loan and is counted towards the points and fees. I'll run an example real quick by you. Our average loan amount last year was 1.2 million. We're trending 1.3 million this year. Our minimum loan amount is 250,000. Our maximum loan amount is really 3 million. And so let's just use $1 million. And let's say, all the points and fees are $28,000, and I'll get into that in just a minute. And the borrowers gave $20,000 in earnest money for the $1 million purchase. Well, if the points and fees are 28 and they paid 20, there's an $8,000 deficit. Sometime at or before closing, the borrowers are going to need to wire an additional $8,000. We also allow gifts, and I use that term loosely. We just like the recipient to receive the gift from the donor, and then the recipient or the borrower wires the money to title. We don't like the donor sending the money directly to title because of the paper trail and the challenges involved with that. So that's how we're able to kind of pass our auditing when we get audited to show that the points and fees were not financed. Wait a minute, Peter. You said earlier that borrowers can get cash back in the funding of the loan, so why are they sending more money in? Again, it's one of the idiosyncrasies of a Section 32 loan that points and fees cannot be financed. However, once the loan funds, depending on what the loan amount is, they can get all that money and then some back. So hopefully that kind of clarifies what I was talking about there. All right, so you can clearly see how this singular solution is really, really powerful. Let me talk for a minute to you guys, since you're real estate agents. How many of you have a pipeline of future buyers that are currently sitting on the sidelines because they have a home to sell, and they have no motivation to sell that home right now for numerous reasons? And you're agents, so I don't really need to get into, the reasons why, right? If they have kids and dogs and pets, and they got to keep the house clean, and, they don't want to be able to get emotionally attached by depersonalizing their home and putting away all their memories and pictures and all that, we'll bypass all that. But there's a lot of reasons why people don't have the motivation to sell today, but they may want to buy. And they didn't know that there is a true bona fide, easy to qualify solution to be able to help them do that. Well, what if now you can go to these future buyers, they're sitting on the sidelines, and get a percentage of them off the sidelines out into the marketplace today, and go find and buy a home today, create a buy-side transactions for you today. When they close on that new purchase and they move into that new home, guess what? Now it's going to open up a listing opportunity for you to go and sell that departing residence. And so it's great for you guys because you can get two sides of different transactions, which is very important. And as a Clearview mortgage broker, you get paid on the bridge. And then when they sell the departing residence and need to refinance out of our bridge loan through the takeout, you'll get paid again doing that loan. So you guys get paid twice doing a bridge loan with us. It's great for builders if you guys ever work with builders, because now your borrowers can make these non-contingent offers that builders wouldn't accept in the past with contingencies. And then it's great for homeowners. Speed, agility, no debt to income restrictions, no appraisals, stated income, one set of guidelines and documents to sign and close on. It's a pretty cool program. Now, there's one thing. Although this loan is considered a purchase, according to TILA, it's a cash out refinance because we're collateralizing the departing residence, which is a primary residence. And I don't know if you know much about refinances on a primary residence, but TILA says there's a 3-day right of rescission on a cash out refinance or a refinance of a primary residence. What does that mean? That means that the day that the buyers want the keys and the day the sellers are expecting the funds, is not the same day that the borrowers are going to sign all the closing documents. The borrowers are going to sign all the closing documents several days before you guys are ready to fund and record. TILA says 3 business days. So, if we closed the loan, signed it on Monday, this past Monday, then Tuesday, Wednesday, Thursday at midnight, the loan would be eligible to fund, which would roll to Friday. Friday, everybody would disperse, record, fund, and be happy. Hopefully that makes sense for you guys. Don Bialkin is our longest tenured AE here at Arrival Home Loans. He is Clearview Capital's AE. And so hopefully when you guys have, scenarios, you're going to reach out to your Clearview folks who will then reach out to Don, run the scenarios by, and we'll kind of work with you through all those deals. I'm on the East Coast. I'm Peter Zomick again, and our email addresses are really easy. You'll get a copy of this deck, so you'll have all this. So if you guys are really early people and you need to get a hold of me, I'm here. Or if it's getting late in the day, Don is on the West Coast timeline. Now, I'm not going to spend a lot of time getting into this on this call because Don does a great job coaching and helping folks through. We do have a third-party origination portal where Clearview would be able to request a login to our portal, and they'll be able to export a loan out of their origination system as Memismo 3.4 and upload it into our system. There are 3 arrival documents that we require your borrowers to acknowledge, and they can be e-signed. One is a loan purpose form, one is an e-consent form, and one is a certification and authorization. And then as the mortgage broker, we ask you to fill out a loan summary, which just talks about the details of the loan of both different properties, because there's no LOS that really does a great job for cross-collateralized consumer bridge loans. And then in that, we also give you an opportunity to talk about the strengths of the file, what the exit strategy is, how long do they intend to hold this loan, and are we plan A or plan B? Listen, the nature of our product, I know sometimes we're the backup offer, we're the backup plan. For the sake of the relationship, we're not going to sit on your loan to the last minute until you tell us whether you're really going to follow through with it or not. When you submit a loan to us, we're going to work on this loan as if it's closing. However, for forecasting and the sake of communication in the relationship, we want to know, are we plan A or plan B? We have about a 40% fallout of our loans. And I'll tell you that we know that going in because we're the backup. But for a lot of people, 20% of our loans, we're automatically plan A because they're coming to us at the last minute. Due to the nature of our business and how successful we've been, and we're growing month over month and year over year, we are looking for 21-day closing times right now. Great. We'd love 30, but we'd like at least 21. If you have something that's an emergency under 21 days, don't say, Arrival can't do it. Reach out to Don. If we can accommodate it, we absolutely want your business. We want to save the day. We want to help you. So we need to know about it. We've done them in as little as 10 days. Our average, for the first half of this year has been about 16 days to fund. But like I said, just due to staffing and a lot of the moving parts and how much business we have, we're at about 21 days. 17 we normally can accommodate, but just talk to Don if you have something where you need less than 21, and we'll be able to get back to you fairly quickly to let you know if that's something that we can do or not. And so we do disclosures, we do the documents, we work with title companies, we will open escrow if you haven't opened it, and we'll work with escrow and title companies, and we'll train them on what to do, how to structure the deeds of trust and the release clauses. A lot of title companies are not familiar with cross-collateralized bridge loans. Don't worry, our ops team is phenomenal, and they do this all day, every day. We'll get everything set and correct for closing. All right. So that's really all I have.
Hey, Peter.
Yep.
I just want to jump in real quick. This is Bill, the broker. I just want to let everyone know, because I know we have, I think, a million, some of our loan officers on here, as well as all of our agents. One thing to know straight away is Clearview is already approved with Arrival. So as Peter mentioned, they're a wholesale platform. And so Clearview is already approved with Arrival. So that's great. I've already been through the submitting process. I've already seen that. I've already worked with Don. Very smooth. They're very responsive. So that has already been done. So I've already experienced it. That is great. This is an amazing niche. I mean, you guys can see the power of this. This really does a lot of things depending on the circumstances of your client. One thing I think Peter mentioned too is we've talked about this in trainings with Kevin about the power of staging homes. Well, if you think about this, And Peter mentioned too some of the challenges with a departing residence and being able to stage and then get into the the up leg property. Now you have a chance to get out of the property, get into the new property, and properly prepare the exiting property and get more for the home. We already know the stats show staging properties get more per sale than they do if you just don't do those things that need to be done to get top dollar. So amazing, powerful tool there. We're also at Clearview well versed in credit analysis and the rapid rescore that Peter mentioned. So if we are on the fence or we're on the borderline of a 680 FICO, we can figure out how to push that over the edge there, whether it's paying off a collection or something small, paying down a credit card, whatever it is. We know how to get the score up. So that's a no-brainer. The interest only feature is awesome. You're not making a full principal and interest payment. You're making an interest only payment until you're ready to refinance down the road. Renovating the up leg property, that's another big point for me. Is like Peter said, you might be buying a home that needs some work. Well, you can be flexible with the amount of money that you borrow that will anticipate those costs moving forward as you get into your up leg property. That's an amazing tool. The client that I was working with Leanne Thomas, wanted extra money for the pool. The pool was in a little bit, kind of an older pool, and they wanted to upgrade it, and that was going to be factored into the financed amount. So, and additionally, we are sitting on record equity. We know this. The stats are off the charts, especially a lot of people never they've been paying down these low interest notes for years now because people got a little bit paralyzed with the higher interest rate market. But people have been paying down these loans, and on top of that, receiving record equity. There's a ton of equity to be accessed and to leverage into moving now. Maybe moving wasn't on the table before, and now there's a solution. And two transactions is an amazing way to help your client and also help yourself, for a mutually beneficial, outcome. So just so many really powerful things, and that's why we wanted to bring Peter on this webinar today, because solutions and tools and things that can be powerful in our day-to-day business is really important. And you guys know that me and Kevin, we always are trying to bring things of value to you every week. This is what we do, and I hope if you guys have any questions for Peter, you guys can type them into the chat. But we are already approved with Arrival, so you can reach out to Amelia, myself. We're in communication with Dawn and Peter if needed, and so we're ready to go if these scenarios are in your wheelhouse. Today, tomorrow, or next week.
No, that's great. And we do have a few questions. So first of all, Stephanie asks, will the slides be available after the meeting? Yes. So Peter's going to provide those to me. I'll be able to zip those over to you guys, anybody who's interested. Also, Suzanne asks, what are the interest rates on these bridge loans?
Great question. So like Bill did mention, we have, a broker agreement with Clearview, and the broker agreement is structured at 2.5 points. So those are borrower paid points, so there's no EPOs. Out of the 2.5 points, Arrival retains 1.5. Clearview gets 1. We have a $24.95 underwriting fee, and Clearview can charge up to a $995 processing fee. Our interest rates start at 10.5, and that's our average interest rate as well. So hopefully that answers your question. So compared to, a normal conventional loan, 2.5 points, you may have some sticker shock. I'm telling you, our average loan amount is 1.3 million, and our average points structured broker agreement is 2.5 points. So that can seem like a lot, $28,000 or $25,000 at 2.5 points. But as agents on the call, let me ask you a question. If you got a buyer that finds a house that they really like, but there's competition, and the selling agent says, hey, have your buyer make their final and best offer, by 10 p.m. tonight, would that buyer pay 2.5% over asking price to get that home if they really liked it, knowing the home's going to appreciate, and knowing if they wait, they may lose out and things like that? Most of the agents that we talk to say, yeah, 2.5% is fairly reasonable. Well, instead of paying 2.5% for the home, they're paying 2.5% for the bridge to be able to buy that home before they sell their existing home. So hopefully that, answers your question there.
And
yeah, that makes a lot of sense, Peter.
And
Yeah.
just to also just touch on that, like if the staging portion comes into the equation, we know statistically they're going to get more than 2.5% more for staging the property and getting the exiting asset into top tier condition. So you can pick up and surpass the 2.5% in that equation as well. So that's something that's a really good selling point, I think, in that scenario.
Yeah, it's important to put the points and fees into perspective with how you can recoup those through, what Bill and I just mentioned. There's a question here about, does a program work for 1031 exchange? So yes and no. So remember I said our parent company, Pacific Private Money, they do full investment property bridge loans. They do 1031 exchanges. They do reverse 1031 exchanges. The only way that a rival can do a 1031 exchange is if it's a 2 to 4 unit and the borrowers live in at least one of the units and they're buying another 2 to 4 unit and going to be living in at least one of the units, because then for us, it's considered a primary residence. For the 1031 exchange purposes, it's still bona fide investment property. Don has one right now that's pretty strange, and we agreed to do it. It's a single family residence that a borrower lives in as his primary residence, but he rents half of the house to his business. And he has done a 1031 exchange that way before, and he's buying a new primary residence with a 1031 exchange because he's doing the same thing. He's going to be renting half the house to the business. So pretty interesting. So the answer on the surface is yes, but it could be a little bit more complicated depending on the circumstance.
Excellent. And so those of you that are looking for the contact information for Peter and for Don, I will be putting that information. You guys, or Peter, you can put it in the chat as well, but I will be putting that out when I put the replay of this webinar out this afternoon. So you guys can always access it there. And I'll also be putting Peter and Don, your information in our agent resource center on our website as one of our trusted providers. And so that's where you guys can find that information.
Great. Kevin, do you have our complete lending guide and our matrix as well?
You know what? Just send it to me just to make sure I have it.
Don, if you can get that stuff over to them, I'll get the deck over to you so you can send it all in one email.
No, that's perfect. Well, Peter, thank you so much for being on our webinar. We really appreciate it. This has been really good information, and I know our agents can use this, starting today. So if you guys have questions for Peter and or Don, don't hesitate to contact them. Bill, any final thoughts?
Yeah, I just want to thank Peter for coming on. That was a really nice presentation. I know agents, if you're a realtor, we covered a lot of territory. I think we targeted the main takeaways. There's always going to be additional questions. So once again, Clearview's already connected with Arrival. I've already done the process myself. I can answer any questions along with Amelia, and then we will direct those towards our rep. Dawn is our rep, so that is our liaison in the connectivity of the two companies. So that's the process you'll want to go through it. You reach out to us, we go through Dawn. That's the wholesale channel. Once again, they're not a retail bank. They're a niche bank, a wholesale, which is a great buzzword too for your clients. And yeah, we'll take great care of you.
Great.
Awesome.
Well, we appreciate the opportunity for the partnership. We appreciate helping salvage deals and create transactions for you guys as well. And Don's one of the best. So you're in good hands with him, and we appreciate the time that you allotted for us today. And we wish you guys the best in using our product to create more solutions.
All right. Well, thank you guys so much. And agents, get out there, make it a great week and a productive week. And we will see you all on the webinar next Wednesday. Thanks so much.
Bye, everybody.